Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, the outlook for 2026 is full of uncertainty, so is there any good news? And Calgary's water main break highlights a common problem across this country. Plus, is capital increasingly wrapped in the flag? That's all ahead. First, for the week that was in business, it's time for the briefs. The federal strategy for autos in Canada includes $3 billion for the industry to adapt and $2.3 billion in incentives to buy electric vehicles. New EV targets aim to be at 75% of total sales by 2035 and 90% by 2040. And the government says new trade agreements will bring additional manufacturing here. A new report highlights a dramatic decline in the share of cars in Canada being made by U.S. automakers, as the proportion of auto manufacturing by Japanese companies has risen. The Trillium Network for Advanced Manufacturing showed that overall the number of cars assembled here dropped from 2.3 million in 2016 to 1.2 million in 2025, and that much of that decline was from U.S.-based auto companies, Ford, GM, and Stellantis, which made 56% of the cars in 2016, but only 23% by 2025. The U.S. is creating a critical mineral reserve worth about $12 billion to create a stockpile and ensure supply of the sometimes rare and hard-to-process minerals. Project Vault will be funded by the U.S. Export-Import Bank. China controls about 70% of the world's rare earth mining and 90% of global rare earth processing. Canadian mining firms Eldorado Gold and Foran Mining will combine in a $3.8 billion share swap. It comes as the prices of gold and silver had risen sharply, even with a recent sell-off in the precious metals. Eldorado has a massive gold and copper mine under construction in Greece, while Foran is starting to work on production of a gold, silver, and zinc mine in Saskatchewan. On time and under budget are not words we normally associate with big projects, but Ontario's refurbishment of the Darlington nuclear facility appears to be both, with the fourth and final reactor ready 4 months ahead of schedule and $150 million under budget. Darlington is also charged with developing 4 small modular reactors adjacent to the station. And those are your business briefs. Canada's economy isn't expected to sizzle in 2026, but could improve as the year goes on. Of course, it's an outlook that comes with some caveats. Don Desjardins is chief economist of Deloitte Canada. Don, thanks for being with us.
Oh, thanks for having me.
It's the caveats I want to start with. You saw the Bank of Canada with the uncertainties risk writ large. How do you forecast? Because you are saying maybe a slight pickup towards the end of this year into next year, but there's an asterisk on that, of course.
Absolutely. And really the big asterisk is our assumption about keeping access to the U.S. market at relatively tariff-free rates. Now, obviously not in some of those bigger sectors that we are really being impacted with, but nonetheless, we are making that assumption. And as you say, it is a big one. And we do assume also that we will see some traction in terms of some of the government policies that have been announced are going to be put in place.
And what are you watching for specifically there? Because that, of course, we've seen a lot, and there's things like Buy Canadian, changes in procurement. You would hope to see things reasonably quickly. Infrastructure, of course, can happen pretty quickly. Is there anything that you're really watching closely?
Well, it really is just getting some traction on these announcements and these programs, whether it is the Port of Montreal, all of these different components. I think we need to see something happen so that businesses who right now are feeling very unsure about where they should be investing, if they should be investing, that they'll take that as a signal, and that will help with getting a little bit of that money into the economy, because as we all know, that is one of the areas where we have been really lagging in terms of money being spent.
One thing, of course, with money being spent has been the slow pace of business investment. Businesses like certainty, Don. They want to know an answer to what does the next CUSMA iteration look like. Do you think we get that? Are you kind of counting on some kind of resolution to those negotiations this year, this summer even?
We are actually. We think that we're going to have that deal, whatever it's going to look like. I'm not saying it's going to be the same as we have right now, but we do think that given that a lot of U.S. companies rely on Canadian goods to feed into their supply chain, that we will see a deal being struck. Now, whether or not it does have some caveats or some changes, and we know that even if we do get that deal signed or the review signed, anything can change. So I think from the perspective of Canadian businesses and what they're thinking about, they're thinking about where a rate's going to be. And also, can they actually kind of piggyback, if you will, on some of the government's spending initiatives? So that too, all of that kind of has to move in tandem, I think, for us to actually see that money being spent by businesses.
Are you worried about the government spending and the level of debt that includes and the costs that come with those, deficit spending?
I usually am, but at this stage, I have to say, I think we need the infrastructure being built. And when we look at some of the metrics that say, okay, what suggests that we're not in a great fiscal health? Well, if we think about debt service as a percentage of our revenues, for example, government revenues, that number is running at about 10, 11 cents. When we were really worried about it, it was about 38 cents. So I think there is still fiscal room for the government to continue to spend, to get us up that curve, and hopefully, and I'm thinking this is going to happen, restore confidence by Canadian businesses.
Is there room in forecasting for a best case scenario, the upside surprise that could come?
Yeah, I mean, there's always hope. When we think about our forecast for 2026, I mean, we're not looking for a huge surge in activity. What we're looking for is growth of about 1.5%. It's going to be, in our view anyway, a soft start. So growth rates that are running 1.25%. So not all that rosy. It really begins to pick up once we get some restoration of confidence. And it's confidence for businesses, but that flows through to the consumer as well, because the consumer, is also facing a lot of uncertainty, soft job market. We do know that lots of Canadian mortgage holders are going to be renegotiating in 2026. So there's all of these factors at work. We do think that will, once we get this confidence being restored, we do think that will set up for stronger growth. But again, I think when we think about 2026, we're not going to look back and go, oh my goodness, that was such a strong year. Is there a risk? Sure, of course. If we somehow get some kind of amazing deal that the U.S. just signed off and we're back to where we were before, sure, that could be that confidence lift, and it could come a little sooner.
So good to have you, Dawn. Appreciate your time today.
Thank you.
Dawn Desjardins is chief economist at Deloitte Canada. Coming up, with another water main break shutting down its system recently, Calgary became the front line of the Canadian municipal infrastructure deficit. We've got the mayor of Calgary on what happens now. Welcome back. Canadian cities are sitting on top of aging infrastructure with very real cost. Here's a look by the numbers. The national infrastructure deficit, which includes fixes needed to roads, bridges, water systems, and transit, is estimated at $270 billion. The cost of much of that infrastructure falls to local governments. They own 60% of that core infrastructure, but get 8 to 10 cents of every tax dollar collected. Meanwhile, with a push on to build more homes, it's estimated that $126 billion of housing-enabled infrastructure is in poor condition or at risk of near-term failure. That's 11% of the total. Meanwhile, water systems are a core culprit, with a replacement value of $107 billion and drinkable water losses up 13% between 2011 and 2021. Meanwhile, extreme weather costs are adding up. Insured losses hit a record $8.5 billion in 2024, but uninsured losses could be even higher. The issue is very much in focus in Alberta. A pipe carrying 60% of Calgary's drinking water burst for a second time after $38.2 million was spent patching it in 2024. Calgary will spend $1.1 billion implementing upgrades. Calgary's total infrastructure gap is estimated at $7.7 billion. For now, Calgarians' water is back to normal, but there's more pain ahead as the city makes plans to repair the pipeline that caused last year's leak. I spoke with the mayor of Calgary, Jeremy Farkas, and asked him for an update on the status of that breakdown.
So for a city of almost 2 million people, we have about 60% of Calgary's water goes through one single pipe. And unfortunately, this pipe is terminally ill. It's a ticking time bomb. There's no amount of patchwork that's actually going to be able to get it into a shape that'll last in the long term. So it could continue to break next week, next month, next year. We just don't know, which is why we have to move faster than we've ever done anything before to build the replacement. This is typically a very complex project in the tune of hundreds of millions of dollars, would usually take about 4 years, but we've set a really ambitious goal to be able to finish this in one single calendar year. So we're hoping to do in one single year what otherwise would take 4. And going into our spring and fall, we're anticipating some more proactive shutdowns, asks of Calgarians to help support water conservation measures. But in the short term, we are monitoring the situation and we're moving fast to fix this, not just for the next week or next month, but for hopefully the next 100 years.
Calgary is promising to move at record speed on the pipeline repair. I asked Mayor Farkas how he will do it.
So a big piece is procurement. We moved to immediately sole source the contracts for project management, as well as the micro tunneling. We're using a micro tunneling technology about 30 meters below surface. And this allows us to avoid the typical delays that you would think of in terms of surface level construction. Along this corridor, it's one of the busiest areas of Calgary, with hundreds of businesses, tens of thousands of Calgarians living in the vicinity. So going deep underground actually allows us to be able to do this with minimizing surface level considerations, as well as there's going to be a cost to it. So of course, there's incredible amount of cost to hundreds of millions of dollars of infrastructure. But when we think about the overall city budget, we were able to allocate a significant portion of this back in November in our recent budget discussions. And the fact that this is infrastructure that we'll rely on hopefully for the next 50 to 100 years allows us to be able to spread out the cost to be able to justify some of those cost increases.
The cost of maintaining the water system is supposed to be borne by current users. I asked Calgary's Mayor Farkas if Calgarians today are paying a price for work that should have been done years ago.
Well, a big thing was successive city councils and city administration that had not provided proper oversight to the not just the funding, but also some of the governance, the proactive maintenance schedules, and so on. And I want to be really clear that as the mayor of Calgary, public safety resides with me. Public accountability for this rests with me. We understand the problem and we're moving really fast to be able to solve it. And from coast to coast to coast, the infrastructure deficit is a big issue for municipalities, period. I've been having a lot of conversation with other big city mayors. All eyes are on Calgary in terms of what the issue is, how this problem occurred, but more importantly, what we're doing to fix it. But this is a live issue for many other cities across Canada in terms of, and I'm going to be blunt here, just the lack of sexiness of the critical infrastructure underneath the ground. You know, it's relatively easy to support spending the money on the things that your constituents and voters will see versus asking with transparency to pay for the things that they don't necessarily see. Our council is doing things differently. We're going to be very transparent, blunt with Calgarians in terms of what went wrong, how we're falling short in terms of how we fund this, and also ultimately what it's going to cost. But we think by being proactive, we can actually help taxpayers and ratepayers save money. An example is we lose about 25% of Calgary's treated drinking water right now due to the aging nature of our pipes. If we can spend the money modestly now to be able to fix our pipes, we could potentially reduce the rates that Calgarians pay over the medium and long term significantly. Think about it like properly maintaining your house. You can skimp in the short term, avoid making those roof repairs or furnace repairs, but in the long term, you'll only pay more. So there is actually a strong fiscal case for dealing with this here and now, and that's what our council has chosen to do.
While the city of Calgary plans to spend heavily on renewing its water infrastructure, I asked Mayor Jeremy Farkas what role other level of governments should play.
Well, certainly the Prime Minister and this federal government have put unprecedented levels of funding on the table. And certainly here in Calgary, we're going to want to make sure Alberta gets its fair share of that and that Calgary gets its fair share of what Alberta gets. The cost is significant. However, I would ask Canadians to think about what's the cost of not dealing with this, right? We had 2 million people who are on the brink of running out of safe, reliable, clean drinking water here in Calgary. And, you know, it was a Calgary specific concern, but this could have happened in many other cities from coast to coast to coast. This is a really essential service that we have to ensure that we're properly funding. And if we avoid those costs, we end up just paying way more over the long term. So yes, there is a cost to dealing with this, but the cost to ignoring it is arguably much more severe and much more disastrous in terms of potential for loss of life.
I asked Calgary's Mayor Farkas if moving faster on the waterline repair will help the city get speedier on infrastructure building in general.
That's what we're hoping to do. We are rallying to make this Calgary Civic missions, Calgary Civic moonshot. We've done hard things before. We've gotten ready for the Olympics in less than 5 years. We built our Saddle Dome in about 2. We're not afraid of taking on hard challenges like this, and it's going to require Calgarians to work together. It's not just an engineering challenge. We are going to need to see proactive shutdowns of our water pipe over the spring and fall, which means that Calgarians are going to have to help support us as we deliver this needed work. And as well, we're thinking about what it means to be that city of 2 million people. We have about 200,000 people moving to the Calgary region on a yearly basis. This is an exciting place to be right now, and we want to make sure that as we continue to grow, we meet those needs in terms of housing, safety, infrastructure, all those core services that municipalities deliver. And we also need to be thinking about infrastructure, not just in terms of the pipe in the ground, but also people, the services, dealing with some of those issues around, say, crime prevention, safety, mental health, addiction. This is as essential infrastructure as any water pipe. And our hope is that here in Calgary, we can show the rest of the country what it looks like to be proactive, to deliver on those quality services, but ultimately save ratepayers and taxpayers money by dealing with the problem here and now, rather than leave it to some other mayor and council to deal with.
Jeremy Farkas is the mayor of Calgary. Coming up, a U.S.-based tech investor says it will no longer put money in Canadian companies. Stay with us. Welcome back. A major U.S. tech accelerator ruffled feathers recently when it said it would no longer invest in companies based in Canada. Is this a sign of economic sovereignty at play, a kind of reverse elbows up that might make it harder for Canadian startups? John Ruffalo is managing partner of Mavericks Capital. John, great to have you with us.
Great. Thank you, Amanda.
So Y Combinator, well known in kind of the tech accelerator space, maybe not to a broader audience, but it did raise eyebrows. Is this a kind of a weird, wrapping in the flag issue, or is it about something else in your view?
Yeah, it's about something else. I think people's immediate reaction was, uh-oh, is this another one of those geopolitical tit for tat? But when you started to dig down deeper, there was really something else at play here.
And of course, capital is a pretty important part of the picture of developing Canadian champions. You've been a huge part of that over time at Mavericks Capital, previously at OMERS, at the venture group there. How are we doing, John, in terms of getting the lifeblood of capital to Canadian startups?
Well, this is really the underlying issue and the real sensitivity. Really, ever since the COVID crisis, this has been really on a downward trend. And here we are, talking about the biggest topic at hand is rebuilding Canada, Canadian economic sovereignty, but it takes capital. And the capital that we have in Canada is needed in Canada to build these startups. And what happens is when this capital goes elsewhere, and we think that foreign-based capital is going to come into Canada to plug any hole, the reality is every single country in the world, including the United States and China, is looking at their own sovereignty issues, and they're protecting their own domestic capital as well.
And tell me how much it matters if a company does redomicile, because we see it all the time. Companies move to, it used to be Silicon Valley, now you see a lot of Florida or New York. Does that make a huge, are we losing the talent and all the fringe benefits of having that homegrown entity?
Yeah, so this is really the issue. So the real concern has been the young entrepreneurs who are graduating university are getting increasingly frustrated, and there's been a lot of friction in Canada with them building their companies. So, they believe, and in some cases it's true, that by going to a much more friendly jurisdiction where there's a lot of people willing to write checks, it just makes it easier to build the company. And then the moment that the founders decide to leave, then of course the company is not here. And if these become a big win, then Canada loses out, particularly where Canada was responsible for the training and education of these folks. And then when it's time to realize it's another country that's benefiting, this will be a real detriment to Canada over the long run.
What can we do about it, John? We can obviously encourage investing. Do we encourage our big pension funds to invest more in Canadian startups?
At the end of the day, if we're not supporting our own homegrown opportunities and talent, it will be gone. Maybe not immediately, but slowly over the course of time.
John, so good to have you. Appreciate your time.
Great. Thank you, Amanda.
John Ruffalo is managing partner of Mavericks Capital. Time for the takeaway and papering over a gaping hole. The recent offer from the federal government to help offset the rising cost of food will be well received. Food inflation has remained perniciously high since it took hold post-pandemic. And since food is a non-negotiable item, it's the one that hits everyone and the most financially vulnerable even harder. The GST credit already exists and some 12 million Canadians already qualify. Now rebranded as the Canada Groceries and Essentials benefit, the payment amounts will rise. For a family of 4 receiving the credit, the difference could be about $700 more this year and then about $300 a year extra for the 4 years that follow on top of the existing credit. It's a means-tested credit, but the thresholds aren't terribly high. Now, the Parliamentary Budget Officer has an estimate of the cost of this inflation fighter. It's more than $12 billion over the 5-year increase period. Again, that's on top of what the government already spends on this credit, which is about $6 billion a year. Is there anyone who will complain about relief at the grocery checkout for hard-hit Canadians? Well, maybe not the relief itself, but the form it's taking. By giving up taxes from some Canadians, the government will either have to collect more taxes from others or borrow the difference. That is just the math. But more importantly, the rebate doesn't actually solve any of the underlying issues that cause food inflation. Some of those are Canada-specific and include concerns about a lack of competition in food retailing. You might also point to monopoly-like positions of some big food companies or the supply management systems that control supply rather than price. But the biggest driving force of the current jumps in food price have more to do with climate change, extreme weather, and trade wars than anything close to home. None of those will be solved by offering financial support at the till. My takeaway? Having clear conversations about what is actually making food prices jump might help us actually tackle the cause itself. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.